I'm Darius McDermott from Chelsea Financial Services, and today I'm delighted to be joined by Stuart Rhodes, who is manager of the M&G Global Dividend Fund, which sits on the Chelsea Core Selection. Stuart, good morning.
Good morning. Thanks for having me.
So look, your fund since inception is all about dividend growth and stocks that continually grow their dividend. That's what this fund is all about. What are you seeing in the marketplace generally about companies that are able to grow their dividends? And given the dividend shock of 2020, what does dividend and dividend growth look like in 2022?
Sure. So as you rightly say, we went through a very significant shock in 2020. It was actually quite a bit worse than what we went through in the financial crisis. So it was a major shock. And then since then, we've kind of been rebuilding those dividends and the confidence in the dividends to recover back to their previous levels and hopefully resume the sort of trend line and growth that was happening pre, I guess, the initial part of 2020. And that's what we're kind of zeroing in on and trying to focus on is the businesses that, even if they did have a little bit of a wobble in 2020, just because no one quite knew how to react to that kind of initial shock, the companies that have quickly resumed back to the kind of trend line of growth that they would have been on had it not been for that shock in 2020. So we've seen a pretty decent recovery in dividends in 2021, and that has continued so far in 2022. And we're feeling pretty confident that we'll still be able to deliver on dividend growth as we look forward for the next couple of years. I guess that confidence has obviously slightly been dented by recent dynamics, not only in terms of the Fed having to tackle inflation, but obviously what's going on in Ukraine as well. However, we still see a pathway to dividend growth, continuing really from that shock in 2020 going forward over the next couple of years.
Are the majority of your companies back at their pre-pandemic dividend level? X the dividend growth question, but are they have they managed to reset at those levels, or are they a little bit behind?
I mean, basically you hit the nail on the head in terms of that's our key test. So it's quite unusual for us to give companies passes on any kind of dividend reduction or dividend cut. But we wanted to be pragmatic about how we approached 2020 because obviously it was a very sort of unique time period. And we thought, certainly in Q2 2020, when no one knew what was going to happen, we thought it was very sensible and prudent of a lot of boards of companies to be very cautious about their dividend. And so we had some companies actually not paying dividends in 2020 or cutting their dividends while still being in very, very strong financial health. So we wanted to try and focus on the companies that have quickly resumed back to the previous level. So 2019 dividend is the base that we are looking at. And companies that have resumed back at that level or are now above it and growing are the companies that we're looking to select and have as the dominant driver of the portfolio. And, we've been happy and positively surprised about the amount that we have to choose from in that regard, compared to if you'd asked me that same question back in April or May 2020.
Yeah. And you touched briefly on inflation and the Fed, but sticking with equities, can dividend growth keep up with inflation to help with rising costs that consumers and investors are enjoying is the wrong word, but are suffering at the moment?
Yes. So, there certainly will be lots of companies that are capable of doing it, and those are the ones that I think you're going to want to be involved in, because that gives you a natural sort of hedge to protect yourself against the rising costs that we are now seeing, and in some cases they're obviously quite significant. So when we look at dividends generally now at the moment, if I think I've been running this fund for sort of 14 years or so, something like that now, and we've always said we wanted dividend growth rates above the rate of inflation. But as we've said that, it's never been particularly a difficult hurdle to achieve because inflation has been low. Whereas obviously now that has changed a bit, and actually the hurdle rate is higher. So we've got to make sure we really are capable of selecting businesses that are capable of a dividend growth rate that can compete with the new high level of inflation that currently persists. And if if companies are not doing that, and then we think they are vulnerable to some some more difficult performance periods ahead. And we think especially the high yielding businesses that don't have a history of growth, I think, are going to be kind of vulnerable to that. These kind of bond proxies, which I guess was a favorable term a few years ago. These are the kind of businesses that we're going to try and stay away from, and look to companies that are capable of consistently increasing their dividend at the 5 to 10% level, because I think that's going to be necessary to see us through this next period.
Are there any parts of the portfolio that are direct beneficiaries on inflation? Any sectors? I know historically you had energy, which had its ups and its downs. Is that sector benefiting?
There are beneficiaries to a rising kind of input cost environment, and you're right. I guess the more obvious ones are in the kind of materials, energy, producer of these kind of commodities that are rising in price at the moment, and that is beneficial for them. I mean, they also have their input cost issues as well. So that's, again, it's not going to be a rising tide for all there, in terms of there are going to be some businesses that look on the face of it as though they should be having a much more favorable time, but actually their own costs are increasing at a similar pace, or in some cases actually a higher pace. So again, it's about selecting businesses where you genuinely believe there is a structural reason why this, I guess, cost environment that we're seeing is going to persist, and they will be beneficiaries of that, because what they're selling is the inflation of what they're selling is outstripping their own input costs. So definitely energy, materials are two areas which I think you've started to see perform quite well lately, after a period where they've of several years really where they've not performed well. And we're starting to see what happens, and why commodities trade in kind of these ups and downs is because there hasn't been enough investment, and it's going to take quite a reasonable period of time to fix that. And so those companies should be in a position to have a pretty robust dividend outlook to deal with, as you said, the inflation environment that we're now in.
And let's finally then just dig into the portfolio a little bit. Are there any changes that you made, any rotations? I mean, we've seen a dramatic rotation from growth investing to sort of more value-led styles in the last, since September 2021, basically. Yeah. But I know, because I've known this fund and you for so long, this is you look at stocks that have dividend growth, but have you been able to find that dividend growth type of stocks in different parts of the market, or is it business as usual, same old stuff?
So you're right in terms of the rotation and kind of share price reaction of certain areas of the market has been quite significant now, and in a downward trend. And therefore, whenever we go through periods like this, which we have been through a few in the kind of the period I've been running the fund, we always make sure that we are looking to see if there are opportunities in areas that we don't often get opportunities in. And we are interested because the growth area of the market has sold off quite a bit. And so therefore, whenever that happens, we dust off our files of the growth businesses that we like and have dividend histories and dividend track records. And the list isn't huge, so it's a fairly analyzable amount of companies to look at. And basically wait patiently to see if any of those businesses have fallen sufficiently enough that the valuation they're trading at now is much more reasonable and actually a pretty attractive entry point for the growth that they offer. And so that's basically been most of our work so far this calendar year in 2022, is to see if we get an opportunity to do that. We haven't done much so far, but we're sort of warming up. And I am optimistic that we'll be able to sort of add maybe 2 to 3 names in that kind of regard that we think will be, great opportunities for us, and we'll be very thankful for as we look out sort of 3-4 years time. So that's definitely one area that we're quite focused on, is that growth area. But we're not talking kind of conceptual growth or growth that hasn't been proved yet. You know, we are talking established businesses with strong financials that just suddenly are 20, 30, 40% cheaper than they have been for a while. So that's what we're looking at. We're not in the kind of profitless, speculative kind of growth market, which we think has got challenges ahead, as well as what they've had to suffer for the last few months. The other area that we're interested in is kind of more in the quality area, where there are some very good sort of stable businesses that have also sold off quite a bit and now offering a starting yield that is a number that we're not used to for those kind of businesses. So where we can find companies where the dividend yield is above 4%, for example, we're starting to get a few candidates come through in that range, and yet we still feel that their dividend growth potential going forward is pretty decent, and that's another area that we're looking to target and see if we can do anything during this kind of period of market uncertainty. So we're quite focused on those two separate areas, and hopeful of making progress as we move through the year.
Stuart, thank you very much for your time. If you would like more information on the M&G Global Dividend, please do visit chelseafs.co.uk.